Hello, everybody. We're going to get started in a minute or two here. We'll let a few more people join in, and thanks for taking the time.
Yeah, it looks like people are starting to populate in there.
Give it one more minute here as the attendees continue to pop in. Hope everyone's having a nice day. It's a little rainy out there today. Hard to see with my blinds closed. If I open them up though, then the Zoom doesn't work too well. But
yeah, getting the lighting with the camera and all that stuff is it's difficult to do.
now we have these like 1080p HD cameras, so. Well, why don't we go ahead and get started? Thank you, everybody, for joining us today on this beautiful, gloomy Pittsburgh day. But we appreciate you taking the time to carve out a little bit of your day to talk about everybody's favorite subject, which is taxes. And we have a very special guest here today. His name's Josh Jones. He's the owner and CPA for BeanCounters Tax and Accounting Services here in Peters. And Josh has done a lot of work with us and our firm and our clients for many years now. And we're going to have a little bit of talk today about some kind of basic tax information and kind of what you can do to take advantage of some of the various tax opportunities that we have right now. And we'll talk a little bit about some of the potential future tax changes that may or may not happen next year or even in the future. So thanks for joining us. And right now I'm going to turn it over to Josh and give him an opportunity to kind of share some of his thoughts as an accountant and owner of a CPA firm.
Thanks, Josh. Yeah, thanks for having me. Thanks for putting this together. It's a pleasure to be here. I'm happy for everybody who could take the time out of their day and join. I had a couple headlines that we had sent out in the invite to the webinar. So I'm going to jump into those, but feel free to ask questions, stop me. Sometimes when I get going on taxes, I just can't stop. So if something comes up that you want a little more info on, I kind of show some high-level items that I think we get questions about a lot in practice. But if there are other questions out there, even if it's something that's not on this, not that we go over, feel free to ask, and we can try to answer it. I think the first thing that we were going to kind of talk through here is understanding the 1040. I think a lot of people get their tax return and just kind of have no idea what they're really looking at, what they should be looking at. And for me, I always say there's like 5 or 6 lines on the 1040 that you should look at. So I'm going to bring up a 1040 here and just kind of walk through it and just get back to where that is and show you what I think is important on the 1040. So hopefully everybody can see this if I can. Sorry, Josh and I did this beforehand and we had it all working, and now here we go. All right, here we go. So this is a sample 1040, Oxford and Loafer shoemaker. They made their money in the shoe business, and this is their 1040. So kind of the lines I tend to focus on a 1040. Obviously, line 1 your total wages. That's everything you've made via your W-2. You go down 2A and 3A, you have your interest, dividends. An important thing to kind of keep in mind there is a lot of people think, well, I didn't take any of the interest, I just left it in the account, or I didn't take any of the dividends, I just left them in the account, I shouldn't have to pay taxes. But unfortunately, that's not the way it works. You kind of pay taxes a lot, along the way on those dividends. The dividends are taxed at a preferential rate, but that's just something to keep in mind if you have some funds that are in non-qualified accounts that are going to be taxed. So. And then, line 4A here, IRA distributions, that would be for somebody, this couple here doesn't have any, but if you had an IRA distribution, that's where it would show up. Required minimum distributions would show there. 4C, pensions and annuities, pretty self-explanatory. Another big question we get a lot is line 5A. So the unique thing about Social Security is no matter how much money you make, the most that can be taxed is 85%. So if you look at this couple here, they received $25,000 in benefits. The taxable amount there on line 5B is 85%, which is $21,250. So whether you can make $100 million, still only 85% of your Social Security is going to be taxable. Line 6 is any capital gains. Kind of another one that comes up a lot where people think, well, I didn't take the gains out of the account, I shouldn't pay tax, but unfortunately it doesn't work that way. And the other thing too, sometimes you may have not actually sold a stock or bond or still have a capital gain. A lot of mutual fund companies kick those out. Josh can probably talk a little bit more about that, but you may own a mutual fund that you just hang on to, and that there's transactions within that mutual fund that will cause you to have some taxable income. So line 7B to me is one of the most important lines on the tax return. That's your total income. So it's basically an accumulation of everything that you've had. So everything kind of gets added up, and that's line 7B. So that's how much money you brought in any given year. So if you want to say, hey, what's my total income? There it is. It's line 7B. And then we go into the next line here, which is your standard or itemized deductions. Now, in the last 2 tax years here, the standard deduction went up significantly. In 19, it was 24.4 for a married couple. It's going to be 24.8 in 2020. And for a lot of people, they're taking the standard deduction. In years past, I would say 5% of my tax returns that I would do were standard deductions. Now it's probably close to 50 or 60. I'm going to talk a little bit. I'm going to get out of order here since we're on that line of, let's talk about what itemized deductions are and what they are. One of the things that we talk about itemized deductions, high level, they're the taxes you paid, not federal, but state and local, any property taxes. But the kind of the unique thing is that that's limited to 10K now. So like somebody who makes $250,000, they're going to hit 10K just by what they've had withheld in state and local taxes under W-2. So they don't even have to really think about property taxes and pull all that information together, because anything over $10,000 is deductible. Mortgage interest also goes on as itemized deductions. You're able to deduct your mortgage interest on a home that's up to $1 million, $750,000 if you purchase it after 12/15 of 18. It doesn't come up that often, but for some people, we do have to figure out how much of their mortgage interest was over $1 million and only deduct that. And then the other piece of it is charitable contributions. So, with this standard, to be able to itemize your charitable contributions, if you max out the $10,000 of taxes, your charitable contributions and mortgage interest have to exceed $14,800. So for a lot of people, if you don't have a mortgage anymore and you don't give $15,000 to charity, you're going to take the standard deduction. So that puts a lot of people in that in that bucket. So it's kind of something to bring up there, because I think that's confusing, and it's different than what it was in 2017 and previous. So kind of one of the tax changes there in the last 2 years. Going further down to 1040, line 11B. is, or wait a minute, I jumped around here. 7B was your total income. 8B is your adjusted gross income. Everybody asks what your AGI is. 8B is your adjusted, your adjusted gross income is. We just talked about standard deductions. So what we do is we take your adjusted gross income, we back off your standard deductions. We'll talk about qualified business in a little bit, and we get to your taxable income, which that's the important line on the tax return. That's what's driving your tax bracket. So when we look at that number on 11B, and whatever tax bracket that falls into, that's how we're going to calculate your taxes. So, you know, the unique thing here is you're not really paying tax on every penny that you brought in. Your total income versus your taxable income. There's always going to be at least the standard deduction of difference there. So something to keep in mind. And when you get to the next page, we get to probably the line you don't want to see, but how much you pay in tax, and that's line 12A. If you wanted a quick back of the envelope of how much am I paying in federal tax, divide line 12A by 11B, and your, that's what your tax percentage is. This couple here, they added a child that's under the age of 17, and so you get a $2,000 tax credit for that as long as you make less than, I think it's around $400,000 a year. That's something that was new in the new tax code. That used to be a smaller number, so let's go to 2,000 per child. It's only up to when the child turns 17. Some people get confused. When your kid's 18, you don't get that anymore, because you did get it and your kid was 0. That would be the IRS's answer to that. And then you take off that credit, and what's left is what you're actually going to pay in total tax, which is your line 16. So line 12A is your tax. Any credits you get, there are other tax credits. Probably the child tax credit is the most common, but you can get credit for what you paid in foreign taxes on investments, different things like that. Take that and you get to what your actual total tax line is. Unfortunately, this couple here didn't have too much withheld under W-2. They say they have quite a tax bill, and that's how we get to what the line 23 and line 21A or what everybody focuses on is how much is my refund or how much I owe, but nobody really figures out how they got there. And a lot of times your refund or what you owe is just kind of based on what you paid in, not as much of your tax return as well. So, any input on that, Josh? Sorry, I just blew it.
Question: in your opinion, from the personal returns that you did in 2019, compared to prior years before the changes in standard deductions and itemized deductions and various write-offs that were changed, did you see taxes go up or down for most people?
I would say that 98% of people were paying less tax. The people that were paying more usually kind of had unique situations that just, the tax code just didn't work for them. But for most people, even though everybody gets focused on that $10,000, oh, I can only deduct $10,000 now. But because the brackets are so much bigger and they're lower, that really isn't affecting that many people. So even with people who had large itemized deductions previously, when you looked at a tax return year over year, most people were still paying less tax. And it was probably to the tune of, I would say, anywhere from $1,800 to maybe $5,000 to $6,000. People with kids were the big winner. I would say that couple that's dual income, $250,000, $300,000 a year, and 3 kids. I mean, they qualified for the child tax credit, which they never did previously. So you're right there. You're $6,000 to the better.
Sure.
So
that's a pretty good tax savings across the board on average. $18,000 to $5,000. That's
yeah. I don't think everybody felt it that way because there was a little weirdness with the withholding, and so some people, well, my refund's smaller, but you paid less in. So when you look at it that way, some people got less of a refund, but that was just made up because they had less withheld under W-2. But and I have this sheet here. I'll just show real quick, and we give this to a lot of our tax clients. If we forget to give it to you, let us know because we can give it to you. But this here kind of shows and I think this is helpful, and we could talk a little bit about this and on some of the other slides about Roth IRAs and what have you and versions. But this here shows what tax bracket that this couple was in here. So this couple here had a taxable income of what, $135,000. So they're kind of smack in the middle of the 22% tax bracket. The 22 goes all the way up to 168.4 for 2019. So this is a nice kind of sheet to show where you are. We use this a lot when somebody says, well, how much more money before I get into the 32% tax bracket or whatever. This is a pretty easy illustration to show that. And so yeah, it's valuable, and it shows you kind of the different breakdowns. And another thing I tell people a lot is to keep in mind about tax brackets. It's the amount over. So if you made 169, you're not going to pay 24% on all of your income. You're only going to pay 24% on $600. Everything else, it's a graduated scale. So people get so worried about tax brackets sometimes, but if you go $1,000 into the next tax bracket, usually it's not going to kill you. So.
Right. Yep. The other thing that I think we saw come up a lot was for people who were taking the standard deduction and making smaller charitable contributions, their concerns about not necessarily getting a deduction for those. So we've had to get creative in a handful of different ways to try to work contributions in other ways where there's some more material tax benefit.
Yeah, and I think we're gonna touch on the qualified charitable distribution as probably one of the methods you guys have used. The other thing that we've kind of told clients that are in that situation is consider stacking your charitable deduction. So if you're somebody that has a budget of $5,000 a year that you're going to give to charity and you're not able to itemize, maybe consider saving that and giving $15,000 every 3 years to get you able to itemize in the year that you make the giving. So that's a way you can do it, and we'll talk about the QCD a little later as well.
Yep. Yeah, it seems like sometimes the 1040 can seem a bit like a mystery, but when you just kind of break it down to the important lines, it becomes a little bit more revealing. Although, of course, I don't remember how long ago it's been, but not long ago, they just changed the order of everything on the 1040. Same information, but like different numbers.
Yeah, there's all these weird schedules now, which I didn't want to bore everybody with on this return. I think I might have included one. Yeah, so there's a Schedule 1 here to kind of, this couple here, they had a little bit of Schedule C income, did some consulting. So there is a Schedule C on this return. The person made $1,500. So that's kind of where this is all accumulated, where some of this stuff used to show on the front of the 1040 previously, but now there's this additional schedule. So we made the 1040 smaller, but we made the overall tax return bigger. Right. So, yeah. But the 1040 is a good summary. We give people their tax return and it's 95 pages long, and nobody wants to look through that, but most of the information is on the first 3 to 4 pages that you need to look at, and the other stuff just becomes a bunch of just supporting schedules and junk.
Yep. Okay. Good stuff.
I'll stop the screen share here on that, and I think the next thing we were going to kind of jump on to any questions from any of the attendees on the 1040 before we jump into the next round.
Let's check here. So yeah, you can chat. You can type a question in the chat menu here for anybody who may or may not have a question. And I can keep track of those.
Yeah, we'll open it up to questions again at the end after everybody hears everything. But so I'll jump into the Roth IRA. I think that was next on our list, and kind of go over what it is and the benefits of it, and kind of what we think. Somebody just raised a question about Roth conversion, so we can touch on that a little bit as well. So the Roth IRA is an IRA account, retirement account, where you put the money in now, you pay the tax now, and that money grows tax-free. And as long as you take it out past 59 and a half, you won't pay any tax on all that growth. So if I put the money in now, I put my $6,000 in there and I invest in a stock and I really hit a home run and that grows to $1 million, I'm not going to pay tax on that growth to $1 million as long as I take it out post 59 and a half. So as you can see, there's a lot of benefits to that, especially for younger people that are going to get a lot of growth over their portfolio just by the way the market goes up over time. So if you have a 30-year window or 40-year window before you're going to use this money, you're going to get a lot of growth, in there. You're not going to pay tax on it. Now, some of the downfalls to the Roth IRA, number one, you don't get a tax deduction, so people don't like that. But I would tell you that I think the tax-free growth is more than outweighs that. And the other thing is there's some income limitations. So for a single person, you have to make less than $124,000. Married person, less than 196. And then at that income, it starts to phase out. It completely phases out at 139 for single and 206 for a married couple. So kind of the question is, well, what do we do? I make more money than that, and I want to get money into my Roth. So there's a few options, and I'll let Josh chime in here in a second too. So one of the things we would do is a backdoor Roth conversion. This only works if you don't have any money in a traditional IRA. You would make a non-deductible IRA contribution, and then you would convert that to a Roth. There's an IRS form 8606 that we show that. And it's kind of a way for somebody that makes over that income level to get money into a Roth IRA. Only caveat being is if you already have money in a traditional IRA, it's difficult to do because you have pro rata rules and all that. I'm not going to get into it, but you basically have to pay tax on a portion of it depending on the percentage of what your IRA, the Roth IRA contribution is. So there's that. The other option too is if your 401k through your employer has a Roth option, you can contribute to that and not have any no income restrictions there. I'm going to kick this over to Josh here because I'm sure he probably, I know from doing some tax work for his clients that they like the Roth IRA. And, I'd love to hear kind of your side of it, Josh, and what you.
Yeah, no, absolutely. I think the Roth IRA is one of the greatest gifts that the IRS has given investors. The issue with them is that I guess because it's such a good option, they really keep it relatively restricted and limited to who can make contributions and how that works. So, many people get capped with income limitations and are very quickly unable to make those contributions. These days with 401ks adapting the Roth chassis more and more, it's become more available, I think, for investors who may have that option. And actually a Roth 401k for those whose companies do offer that can even perhaps provide more benefits because the contribution limits are significantly more. So where you're capped in a Roth IRA at $6,000 or $7,000 now if you're over 50, you can get the full contribution of a 401k, which is what, 19,000.
Yeah.
You're really able to utilize that on the Roth component significantly more. Roth conversions as well are definitely a part of our planning strategies in general. As you mentioned, Josh, oftentimes if we're looking to just purely use what I would call like the backdoor Roth contribution, which is making that non-deductible IRA contribution and then converting. Typically that becomes a little bit difficult if those people have IRA money. But we oftentimes utilize those for people who do have IRAs to start to carve off pieces of their IRA over time to convert to a Roth and intentionally pay the taxes. So it's more of a tool to get that money out of the IRA into the Roth, knowingly pay the taxes on it. You had mentioned in the slide that you showed where you showed those tax brackets, and a lot of times what we'll do is we'll try to identify how much more in that bracket we have before it would spill over to the next. and oftentimes that can be a good way to convert at that rate, knowing you're not going to spill over to the next tax bracket. And so we'll look at that. We'll get confirmation from somebody like you and say, okay, you could convert another $10,000 without essentially raising your taxes. Yeah, you're going to pay more, but you're not raising your bracket on that level or because of that conversion. So a very unique tool, and the Roth has some interesting estate planning uses as well, that may be a little bit too detailed for this conversation. But yeah, I mean, various opportunities for the Roth is great. Looks like we got a question here, so maybe we'll just jump into that. If pulling funds from a 401k and under 59, is there a 10% penalty that gets charged, and how is that tax treated for the fee and withdrawal? How is the amount taxed in order? For example, pulling 100,000 this year.
So there's kind of some unique rules this year for pulling money from a 401k. So if you're pulling money from a 401k and you, I think if you tell them it's for coronavirus, you save that 10% penalty. But you would still, that's going to add to your taxable income. And a lot of times, if we go back to that tax bracket, and I'm gonna bring it back up here just so we can talk and you kind of see it in front of you here. You know, if you're somebody who's going to pull $100,000 from your 401k, and let's say you're this couple here, so traditionally you make $135,000. Well, now you're going to make $235,000. And what happens in that is your W-2 income and what have you is all withheld at how much money you make. So when we add another, you know, $100,000 to your income, and let's say you even withhold 22, 24%, you're probably still going to end up owing because you're making all your other income taxed at a greater rate as well, and your W-2 is not going to keep up with that. You know, so to answer the question, you know, if you would take $100,000 out, it's going to be taxed at your normal tax rate. I believe there's a way, and I don't know the logistics of this because I probably wouldn't recommend it. But there is I think there's a way that if you kind of tell sorry, I don't know what I did, but if you let the bank or whoever holds your 401k know that it's because of the coronavirus, there's some way where you don't pay the 10% penalty. I don't know a ton of details on it because I haven't had anybody do it. Josh, do you know anything more?
Yeah, we've had it come up, and I believe part of the CARES Act does permit for IRA and qualified plan withdrawals in 2020, penalty free. I don't know to the extent that they would challenge how much is really required relative to the coronavirus, but you know, the way it's written, essentially there is potential opportunity for premature distributions without a 10% penalty this year. That doesn't mean, like you mentioned, you're not going to pay tax on it. That hasn't changed. You're still going to pay ordinary income tax on it, but there is, I think, some gray area that certainly people could likely take advantage of if they wanted to pull money out of a IRA or 401k without that premature distribution penalty this year.
Yeah, so I think it maxes at $100,000 and you don't pay the 10% penalty. So kind of the answer to the question there, that's how that would be treated from a tax perspective. One of the things to keep in mind though is that it's probably going to push your tax bracket up, especially a large sum like that. So.
Good question.
That is a good question. So yeah, and it seems like there's another question there too on doing a Roth conversion this year. So you know, we touched a little bit upon that. I always think a Roth conversion, especially if you're underutilized, you know, you don't have a lot of money in a Roth accounts. I think a Roth conversion makes sense to at least get some money in there, and we could look at where you're at in the tax bracket and see if you know, how much makes sense. You know, I think taxes are only going to go up. Just kind of, you know, So either having that money and you've already paid tax on it's a good thing to have. And my thought on a Roth account, just a quick kind of tangent here, and why I like the Roth money, and Josh might have some reasons as well, is what a lot of people don't realize. So you can take your money out of your 401k at 59 and a half and start to withdraw on it and not pay a penalty. But a lot of people at 59 and a half are still working, and they're probably in their highest income years of their lives. And people work now into their mid 60s, 70s, and what have you. So having some Roth money at that point of your life, let's say you're 62, and you say, well, I've saved my whole life and I want a boat, or I want a vacation home, right? I want whatever your goal in life is. Having that Roth money there while you're still working kind of gives you a little bit of money to use tax-free if you wanted to, if that was your goal and you have enough money to do that. Where if you said, well, I'm going to buy a vacation home and I'm 62 and I want to pull it out of my 401k, well, you're going to pay 35% in taxes to do that. You're going to pretty much drain your, to cover the taxes and the purchase, you're going to drain a lot of money out of your 401k. So it gives you some money later in life if you have that kind of lifestyle goal and you save for it. That Roth money, I think, is a good thing to use for that, because a lot of people don't wait until they're done working to make that kind of retirement purchase, or they call it a 60-year-old. Okay, I want a boat, I want a Porsche, whatever. There's a little bit of money there, and it's tax free. So that's kind of my thought there as well. Not saying everybody should buy boats and vacation homes, but
Kelly. Yes, hi, how are you?
Sorry. Can you guys hear that?
We're good.
Okay, all right.
All right, so shall we move on? Roth IRAs, very good. Yes. Anything else you wanted to touch on? Qualified charitable distributions?
Yeah, let's go on to the qualified charitable distributions. I think we touched a little bit on this in our, when we were going over to 1040. The qualified charitable distribution is a nice tool, I think, for that. We talked about the person who wants to make a charitable contribution, can't itemize. This is a way to kind of make that charitable contribution tax-free. Now, you have to be over 70 and a half to do it. But if you say, well, I want to give $5,000 to charity, I'm taking the standard deduction. What basically happens is the money goes directly from your IRA to the charity of your choice. It shows up on your tax return, but it's not taxable. It gets coded on 1099 as a qualified charitable distribution. So that is kind of how that works. And we use it a lot. I don't know if we use it a lot, but where we recommend it is for that person who isn't able to itemize. You're able to do up to $100,000 a year. It's also a good plan for somebody who's trying to get some money out of their estate and doesn't want to pay taxes, and it's going to be charitable anyways. But so kind of two places we see it. Josh, I'm sure you probably have some more input on that as well.
Yeah, I mean, we see this a lot as a great opportunity for required minimum distributions for those who are charitably inclined but don't necessarily need their RMDs. It's just a nice, easy way to essentially avoid some of the taxation on those, which certainly helps, especially when a lot of those people may actually not even get the tax deduction if they're using the standard deduction. So this has become, I think, a lot more popular than in the past, where you could just write a check and take that charitable deduction much easier than you can today. Some interesting challenges for 2020, just in particular, because you don't necessarily have to take an RMD this year. But I think for all intents and purposes moving forward, unless things significantly change in this arena of the tax code, for those who are looking to make contributions, or I'm sorry, to make charitable contributions, a qualified charitable distribution is I think, a very unique and not too difficult way to get some tax advantages and help out different charities. So.
Yeah, I would agree. So I think that's it's a good thing, and we've used it for a bunch of different purposes. I think it makes a lot of sense. Any questions from anybody out there on qualified charitable distributions? Exciting topic, but it looks like we what deduction would a DAF get this year? I'm not. What is a? I don't know what a DAF.
Donor advised fund.
Okay, so your question is, if you put money into a donor advised fund, what deduction you would get for that? I believe it's your full amount that you're able to take in a charitable deduction. So charitable deductions, if you itemize, there are some limits on income, but you know, for most people, they don't fall in. I think you can donate up to 50% of your AGI and still take the deduction. I don't know that I'm not aware. I could do some digging on that and get back to you. I'm not aware of any changes in that role. That's a good question. Any other questions out there? All right, well, I guess we can go on to something we see a lot of these days. Where I'm going to say 1099 self-employed income. We see it from people who aren't, you know, we see it from people who are still employed and, you know, also pick up a side gig, you know, working, you know, doing some consulting work or what have you. So I want to just kind of touch on that based on that because, you know, it presents some unique opportunities when you have some 1099 income. So I'm just going to kind of run through my thoughts on it and then answer any questions. So, you know, naturally, if tomorrow I say, okay, I'm gonna pick up a you know, self-employed gig, I'm gonna go drive for Uber, and I am going to give Uber my social security number, and I make some money, and they send me a 1099. I haven't set up an LLC or anything like that. That money is going to flow through on my personal tax return. It's going to be on a Schedule C. The one thing to realize on a Schedule C is that you're going to pay your tax bracket, your tax rate, which we looked at in the tax brackets there. You're also going to pay self-employment tax. A lot of people, when you say self-employment tax, nobody knows what that is, but it's basically Social Security and Medicare tax. When you're employed, your employer pays half of that, and half of it comes out of your paycheck. Well, when you're self-employed, you pay both sides of it. So it could be, and it starts at $1, so it can be a pretty big tax. It's something definitely to plan for, especially if you just have a small side gig where you're making $5,000 or $10,000 and it's not your own thing. That, you know, you're gonna have that tax plus your federal tax rates. A lot of times that can put you into 30, 35% when you're paying both of those taxes. I think another unique opportunity, and Josh will probably be able to touch on this as well, is having the retirement plans. You know, we've had clients who kind of pick up a consulting gig or side gig, and they do it just to help supplement their retirement income. They're a little bit behind in, you know, what they should have put into their 401k for their life. So they'll, you know, start doing some consulting income and pretty much put all that money into their retirement plan. And there's different options out there to do that. Your simple IRA, which you could put up to 13.5 in, your solo K, and then your SEP IRA. And we usually make a recommendation based on what the client's need is there. To just try to put you know, how much money you need to put away would probably drive you into one of those plans. And you know, so I think that was some unique opportunity there. Josh, do you have any?
Yeah, no, big opportunity for self-employed income for additional retirement savings that you're going to get over and above traditional IRAs and Roth IRAs at that point, especially for a single individual with no employees. And as Josh mentioned, there's a handful of different options, and primarily the differences in those options are going to come down to contribution amounts and some restrictions that take a little bit more detail to kind of figure out which one makes sense. But we help work through what that looks like, and we would utilize somebody like Josh to help us identify from a tax perspective which is going to give us the best value. But for individuals in particular that don't have to worry about employees, there's a lot of options. And not that there aren't for people who have their own employees, but it becomes a little bit more complicated and complex at that point, with having to then offer those retirement benefits to the employees also. And sometimes that changes the motive for that person. But yeah, for somebody doing some consulting who just doesn't have any employees, it's just them, they have some 1099 income, even if it's, you know, a considerable amount or small amounts, some of these small business retirement plans are really nice because they're super easy to manage, easy to set up, easy to kind of maintain, and you can get a significant amount of tax benefits from those.
Yeah, I would agree. And it's another option to go back to the Roth IRA where if you have somebody that's over the income level for the Roth IRA, you could do a solo K and give it a Roth option and get some money in Roth that way as well. So kind of another play there as well. I kind of jumped past the LLC S Corp conversation. I'll do it. You know, this is something I could probably talk for 3 hours on, but I kind of got a quick back of the envelope. The S corporation allows you to kind of limit some of your salary and save some money on that self-employment tax. And some, you know, the flip side of that argument was like, well, then I'm not going to have as much money paid into Social Security. But there's kind of a fine line there, and you know, Josh could probably talk a lot about this, where how much, if you have the ability to limit your income, how much money should be paid into Social Security, how much should be put in other retirement vehicles. You know, one, just for young people, there's a risk that Social Security is probably going to change at some point. And then also, as you make more and more money in Social Security, your benefit doesn't go up as much as what it does. You know, so you're paying more in, but you're not necessarily getting that paying for your buck in benefits. So we kind of look at that, and usually we start to talk, to a client about an S corp. Usually when they hit that $60,000 to $70,000 of net income, sometimes a little lower, sometimes a little more, just depending on their situation, is where it starts to make sense. You can realize some tax savings and do it. Some people like to do it just because it's easy. They put themselves on payroll and they don't have to think about taxes. But where it can save you on taxes is at some of the higher income levels. And then regarding an LLC, my 3 credits of legal studies would tell you that anything you decide to do in life, set up an LLC for it, whether you're going to sell lemonade on the side of the street or you're going to, become an accountant. I think it helps protect your personal assets. Usually an LLC, can be set up for less than $1,000. It's kind of an inexpensive, cheap insurance policy. It's probably more of a legal discussion, but it's something I recommend for clients who are going to pick up a side gig and kind of do it as their full time, or do it and actually be making some money from it. It's going to go on for a couple of years. And I'm just going to touch quickly on deductions for self-employed, because as a W-2 employee, you're really not able to deduct anything. When you become self-employed, there are some deductions that if they're normal and necessary in the course of your business that you would be able to deduct under Schedule C. Mileage is a big one, easy one, keep track of your mileage. I think the IRS rate is maybe 56.5 cents right now. Cell phone, so if you're using your cell phone to make calls, home office, the home office deduction is made a little easier recently, so you can kind of just use the square footage method. So any type of advertising you're doing, and we have a whole list of those. So if you're somebody who's self-employed, I can give you a laundry list of potential deductions, but it's definitely something to think about, because those deductions not only are saving you on your federal tax, they're also potentially saving you on your self-employment tax. So you could be saving 30 to 40 cents on a dollar for deductions that are allowed. So any questions on that? It seems like we have a question here about Social Security. Let me see here. Social Security. I'm sure if everybody saw it, read it out loud. My ex and I were married for 25 years. He keeps telling me that I can collect Social Security, but I think I just missed the cutoff by a year or two when the rules changed on that. He is 62 and I was born in 1956. And so this is the question, if you don't know, since it's really a Social Security question. I'm thinking your question is, can you collect Social Security under your spouse's account, if that's the question? So you can do it. And you could do it at your retirement age. And so you can start collecting Social Security early at age 62, or you can wait till full retirement age of age 66 or go on to 70. But I think when you collect on the spouse's account, usually the spouse would have to be deceased, is my understanding. Josh, do you have any input on that?
An ex-spouse with, I think, 10 plus years of marriage is entitled to their ex-spouse's Social Security records, as long as they're not as long as the person trying to collect isn't remarried. But yes, theoretically, if I was married for 10 years, then divorced, I never get remarried, and my spouse's Social Security filing on theirs and collecting one half of theirs is better than mine, then I believe I would be entitled to file on my ex-spouse's Social Security. I believe the key there is number of years of marriage, and you yourself have not been remarried. So there is, I believe there should be a possibility that that individual would be able to file on their ex-spouse's record. We did get another question about charitable donations. Does a charitable donation have to be to one organization? This is for an IRA, a distribution, or can it be split between several? Yeah, I don't see why it can't be split between several. Josh, is there anything I'm missing on that?
No, you could. I think you can split it up any way that you want within the IRS rules. The only limitation, I don't know if there'd be any limitation by whoever is holding the IRA, but I can't imagine there would be. It just probably would just be listed on their paperwork where the money needs to go. So I'm not aware of any limitation. If you wanted to take $5,000 and give 5 organizations $1,000 each, I don't think there'd be any issue with that.
Right. Yeah, I don't think so.
Because in theory, you don't have to do it all at one. If you wanted to, you could make 5 different checks for $1,000 throughout the year. I don't think it all has to be done in one transaction.
Right.
So,
and back to the LLC, just to kind of reiterate, it's relatively easy if you start a company to open up an LLC, and then at some point, if you want to transition to getting some of the unique benefits, tax benefits for an S corp, it's pretty easy to do that also with an LLC. So you're not going to necessarily have to like redo all of your corporate documents and start over as you evolve from an LLC to an S corp. So that's pretty easy. I'm sure you guys do that all the time.
Yeah, we elect for LLCs to be taxed as an S corp all the time. It's a simple form with the IRS. You can actually do it late. So I've done them in December and made them in effect for the full year. You have to start running payroll in that entity, but there's definitely things you can do. So if you already have an LLC set up, taking that LLC to be an S corp is a very simple process. So, and if you don't have to, you usually want to change your EIN number. You wouldn't really make any changes. You're just really telling the IRS, hey, I want to be taxed as an S corporation, as opposed to a Schedule C or a partnership or however your current tax set. You can do that anywhere along the life cycle. So we've set up LLCs for people. They start making more, they work for 3 or 4 years, start making more money, and then it makes sense to elect to be taxed as an S corp. So it's kind of almost like the life cycle of a business.
Well, great. Maybe just use the last few minutes and talk very briefly about some of the potential changes that we could see in the tax environment, and then we'll wrap up here. I think this has been great, and hopefully everybody has enjoyed this so far. So obviously we have a big event coming up in just a few weeks here with the presidential election, and despite whatever side of the political spectrum people are on, I think it's reasonable to presume that there could be some potential changes to some of the tax codes depending on the outcome of the election. And just thought to see if you have any thoughts on that, Josh, and we can share ours briefly.
Yeah, I agree. So, we have our current tax changes, which have lowered taxes a little bit. And, the tax plan of a Biden presidency looks like it would raise, there's a little confusion. There always is in a president, because, by the time a tax plan gets ironed out, it doesn't necessarily, stay the way that it was originally intended. But one of the things that Biden's ran on is, hey, when I get in the office day one, I'm going to repeal the Tax Cut and Jobs Act, which is kind of what Trump did to decrease taxes. In doing that, we would see a tax raise for probably most taxpayers. Now, when you look at his plan on his website, or when he talks, it more goes over for taxpayers over $400,000. But if you repeal the Tax Cut and Jobs Act, you're going to increase taxes for almost all taxpayers. If you keep the Tax Cut and Jobs Act there and you just make the tax brackets a little different for for higher income, then I think we would still stay the same. That's not 100% clear to me yet, but some of the things that are in the tax plan that I think is your planning that we would want to keep an eye on is capital gains. So for taxpayers making over $1 million, capital gains would be taxed at your ordinary tax rate. And then on top of that, you still have the Medicare surtax at 3.8. So it almost makes your capital gains taxed higher than all of your other income. And also eliminating, this kind of comes into play for the self-employment individuals, eliminating the QBI deduction for income earners over $400,000. So both of those I think are important, because the QBI deduction, I've seen that where that saved taxpayers $50,000 to $75,000. So to take that away, that's a big chunk. The other talk is raising the top tier tax bracket back up to 39.6, capping itemized deductions. Those are things that are going to affect it, but I don't think those are big items. I think the big items are if we get rid of the capital gains tax and we get rid of the QBI, that's going to hurt a lot of people.
Yeah.
What are your thoughts, Josh?
Well, I agree with all of those things, and the other big one that's not necessarily related to individuals, but the corporate tax rate has been proposed to go up from 21 to 28%. I think this one's an interesting one, because although that would certainly reduce profits for companies, and truth is that trickles down to the employees and the individuals. I mean, I think there's no question about that. I don't think anybody thought that the corporate tax rate would stay at 21% forever. I mean, for many years, it was significantly higher than even where it was or what Biden's proposing at 28%. So I mean, it's been as high as 35% for a significantly long time. So I think to some degree, even if that were to happen, it's almost like kind of like a backdoor win, because it's kind of setting the precedence that, well, now 21 to 28% is the new range rather than 21 or 28 to 35. So, from my perspective, I always get the question of how does that impact the stock market? And I almost think to some degree, if the corporate tax rate does get raised to 20%, to some degree, it's almost a win for the stock market, because they can then price in the fact that it's not going to be 35%. Raising Social Security wages, I think you mentioned, the Social Security tax. So, right now it's capped at like $130-some thousand, and that could potentially be added on for people making more than $400,000, which is essentially a 15% tax increase. If you're a W-2 employee, half of that. But again, if your employer's paying more, it's not always just coming out of their pocket. There's, there are less future raises, less benefits that they're going to provide employees if they have to pay more in FICA taxes. So the one thing I think that is somewhat unique is if a lot of these things do get proposed, that's assuming Biden wins the election, but also presidents don't necessarily change taxes, Congress does. So we now have to take into consideration who's controlling Congress. So if the Republicans hold Congress, I'd say we could probably throw all of this out the window. I just don't see anything happening. If the Democrats take Congress, I certainly think there's going to be initiatives, and probably some swift initiatives to get some of these things through. However, the timing is unique because we're coming out of a recession. We have a pandemic going on. I don't necessarily know if even there would be enough Democratic support to move all of these things through. We saw this back in 2008 when Obama took office and he started to push through some tax reform to a Democratic Congress. There wasn't enough support to get a lot of it through. It took many years for Obama to get tax reform through. And at that point, it was pretty much watered down. It still maintained a lot of the Bush tax cut feels that ended up actually coming to reality. But there just wasn't enough support to significantly raise taxes coming out of the '08 recession. And I kind of feel like that's a similar environment we're going to have here, unless there's just a massive Democratic inflow into the Senate that would give enough votes to get a lot of this passed. I don't know how much will really get done quickly. So we'll see. Truth is, taxes are always being changed. You know, there's never a period of time where there aren't any changes to the tax codes. And none of these necessarily, in my mind, are indicative of something that would cause so little economic growth that we would be thrust into a recession or thrust into a bear market. Nobody likes paying more in taxes. You know, that's probably a true statement, but I don't necessarily think that enough will get done quickly enough, just given the landscape that we're in. And I don't even necessarily know if anything that does get pushed through would have too much of a stock market impact. So we shall see, though.
Yeah, the other thing to keep in mind is I think we still, obviously, no matter what happens with the election, the 2020 tax, I don't think you're going to see any changes there. And even in the 2021, it's very difficult for a new president to come in, you get it inaugurated in January, and to change the tax code for the year that you're currently in. So we probably at least have 2021 if there were, and you're right, raising taxes is never a topic that a congressperson or senator wants to get behind. It's not a popular thing to do. So I think even though there's a lot of things on paper right now, I just don't know that it would make its way through.
Yep. And if 2021 we can assume won't change, then you're close to a midterm election anyways, and that's going to make an impact in Congress. And then 2 years from there, we have another presidential election. So things happen. Taxes do get changed. I think it would be hard to significantly reform all of these things we talked about this quickly. So there'll probably be some, and there'll probably be others that don't happen. So we shall see.
Looks like we have a few other questions here before we end up that I see. So somebody has a question on emergency business loans that were issued. Are these taxable? Do they have to be repaid? So the loans that were directly through the SBA, the loan income is never taxable. So if you go, it's just like if you take a loan out for a mortgage, the mortgage proceeds are not taxable. These SBA loans, they're not taxable, but they do need to be repaid. Those are 30-year loans with a 3.5% interest rate, I believe. The payments were deferred for 1 year, so you don't have to make any payments, but the loan is still accruing interest. There's also a paycheck protection program. Those came more through the bank. The paycheck protection program, if they were used for payroll and business expenses, those are potentially forgiven. But if your loan was directly through the SBA, those loans won't be forgiven. They have a 30-year repayment period at a 3.5% interest rate.
Now, Josh, I suppose there are instances where loans that are forgiven end up being taxable, but I don't necessarily know if the IRS has definitively said one way or another. But I think the presumption is that even with the forgiveness, the PPP loans won't be taxable. But have they actually said that?
So there's kind of it's interesting. So they said when the PPP rolled out, they said, okay, it's not going to be taxable. But then the IRS issued guidance and said, well, it's not going to be taxable income, but the expenses that you use for your PPP, the portion that was forgiven, aren't deductible, which essentially makes it taxable. Now there's supposed to be some clarity on that coming out, when, the second round of stimulus was supposed to kind of put some clarification, because it doesn't seem like that was the way that this was originally intended from Congress, and it wasn't the way that it was sold. So right now, the IRS's clarification makes expenses that were paid with PPP not deductible. I think we'll see some changes on that, but that could be, I have clients that have, $3 and $4 million PPP loans. So if we add $3 to $4 million of income to somebody, we're talking a huge tax bill. So I think there needs to be some clarification there, but right now their clarification is saying you can't deduct those expenses if they're, if the loan is forgiven. But then we have a whole nother, what happens if you put your loan in for forgiveness now and it doesn't get forgiven until 2021? So who knows? Hopefully we'll get some more clarification. We have another question about not making quarterly tax payments. If you didn't have the ability to make your quarterly tax payments, do you see anything for changing? Right now, there isn't anything that's any changes on that. So, the 2020 tax deadline is still April of 2021. If you don't make estimated tax payments, the penalty for not making estimated tax payments isn't bad as long as you can pay your taxes by April 15th. So that's something to keep in mind. We have clients who just wait till April 15th and pay all the time and don't make any estimates. And usually that penalty is not too bad. Now, if you go after April 15th, that's where it really starts to, the penalties and interest really start to kick in. So, but there's no relief right now on not being able to do that. The other question here, any thoughts, opinion, if Biden wins, it's just on the economy for 30 to 60 days to try to end COVID while financially further killing in America? I don't, a tough question, a little bit of political question here. I don't know the president has the power to shut down the country. I think that's why currently there's governors that have kind of done things their own way. Obviously a shutdown, we saw what it did in, recently. I would hope that there wouldn't be an all-out shutdown for that amount of time. But I don't know. Josh, do you have any input on that?
I think a national government shutdown is not a good thing for the economy or the stock market, if that's the question. Do I think that will happen? No. But that doesn't mean that there wouldn't be more local and state mandates with high-risk businesses like restaurants and gyms and spas and things like that. I think we could certainly see some clamping down on the local and state level. But let's hope that there's not a national 60-day government shutdown. That's not a healthy thing for an economy.
Yeah, I would agree. So yeah, hopefully that doesn't happen. And I don't think it would go over well. So, but I guess we shall see. And there is one other question. My husband is self-employed and as a consul upon retirement previous job, regarding trader business for the tax break for elected position. Okay, so previously, prior to 2017, there were deductions that you could take if you were an employee, that you would take them on as itemized deductions and what have you. But if you're self-employed, any expenses that are required for your business, you should be able to deduct. There wouldn't have been the only real tax change on self-employed deductions related to entertainment, where entertainment's no longer 50% deductible. It's not deductible at all. But there shouldn't, for somebody who's self-employed, the way the deductions work hasn't really changed. So anything that's ordinary and necessary for your type of business should be deductible. So there weren't any changes that would, so I'd have to look at your individual tax situation, but definitely I'm not aware of anything that would change that you wouldn't have been able to take a deduction that you did previously for self-employed.
Well, thank you, everybody. I'm sure Josh and myself could talk for hours and hours and hours about this type of stuff, but we won't, for the sake of your time, keep you on here any longer. We really very much thank you for joining us, and Josh, to you, thank you so much for your thoughts and your expertise. And we really appreciate your putting the time in to join us today. So.
Yeah, thanks for putting us together, and yeah, I appreciate you putting it all together and getting it out to people.
All right, well, very good. Thank you, everybody, and we will have another one of these soon.
All right, talk to you later, Josh.
Bye-bye.